Negative interest rates, when your bank literally pays you to borrow money but charges you to save it. It's like getting paid to eat pizza while being fined for going to the gym. Yes, this actually exists, and yes, it means the economy has officially lost its mind. So why would any central banker deliberately break the most basic law of finance? Simple: desperation. Well, when your economy is flatlining harder than a Windows 95 computer running Chrome, and traditional tools have about as much effect as a chocolate teapot, desperate times call for desperate measures. Think of it as economic defibrillation. Sometimes you need to shock the system back to life. Here's the play-by-play. The economy tanks so badly that even cutting interest rates to zero does nothing. People are hoarding cash, businesses aren't investing, and everyone's basically playing financial hide-and-seek with their money. So the central bank goes full mad scientist and shoves rates below zero, making it literally cost money just to save. The logic is beautifully chaotic. Punish saving, reward spending. Banks get charged for stashing excess cash at the central bank, which in theory pushes them to lend more. Meanwhile, consumers are nudged to stop hoarding and finally buy that overpriced espresso machine they've been eyeing. It's less about encouraging responsible finance and more about bribing everyone into economic activity. Now let's look at some real-world carnage. The European Central Bank went negative in 2014 and kept rates at minus 0.5% for years. The result? German savers literally started buying home safes because paying a couple $100 for a steel box was cheaper than paying the bank to hold their money. Switzerland took it even further with rates at minus 0.75%, making it cheaper to borrow Swiss francs than to save them. And Japan? They've been stuck in this financial twilight zone since 2016, where mortgage rates can actually go negative. Yes, the bank pays you to buy a house. Sounds amazing until you realize your savings are evaporating faster than water on Mars. And your pension fund manager is basically one bad quarter away from a nervous breakdown. But does this financial wizardry actually work? Well, kinda. The Eurozone did see some recovery, but whether that was because of negative rates or in spite of them is about as clear as mud. What we do know is that it inflated massive asset bubbles, crushed pension funds, and made insurance companies wonder why they even exist. The unintended consequences read like a financial horror story. Banks saw their profit margins squeeze thinner than printer paper, which pushed them into riskier lending. Savers were punished for being responsible, while speculators got rewarded for gambling. And then there were the zombie companies, businesses that should have died years ago, but kept shambling along on cheap loans, clogging up the economy like financial undead. So what should you do if negative rates ever hit your country? First off, don't panic buy a mattress to stuff with cash. That's exactly the chaos central banks are trying to avoid. Instead, look at real assets like property or stocks. But don't go full YOLO. Diversify across currencies and consider things like I-bonds or TIPS that hedge against inflation. And hey, maybe pick up a recession-proof skill, like fixing things. Because when money gets weird, the economy does too. The bottom line? Negative interest rates are like performing surgery with a chainsaw. Sure, they might shock the patient back to life, but there's going to be a mess to clean up afterward. This has been Negative Interest Rates Explained Fast. I am your host, Mr. X Banker. Thanks for watching, and I'll see you in the next one.